Hey, it's Lorne Andrews here from Dominion Lending Center's Expert Financial, OptimalFinance.ca. It seems that homeownership seems to be getting a little bit further out of reach for a lot of Canadians because of the way house prices have been increasing. And what we're finding is there's being a bigger gap between coming up with that down payment that's needed to get into the house that you could potentially want to live in. But what if I told you there's actually a new program out there that's going to help you with this? And I'm going to explain what it is. The program I'm going to introduce you is called co-ownership financing. I think the best way to help you understand how this works is let me give you two family examples. Let's take the Jones family, for example. The Jones family, basically they have a combined income of say about $89,000 and they have about $40,000 saved for a down payment. With that, because they have less than 20% of a down payment, it is an insured mortgage. It has to be insured through CMHC, SIGIN, or Canada Guarantee, which are the three insurers. The maximum amount of time that mortgage can be, or amortization, can be 25 years. The maximum amount of amortization, or the amount of time that loan can be paid, is 25 years. So with all that said, the maximum they could qualify for a purchase price is $400,000. So they were looking to buy a condo, their first home, basically. Here's the challenge. They couldn't find, they also had a child, they needed something a little bit bigger. They could not get into the condo size that they need for $400,000, especially within the GTA. We know how house prices have gone. What if there's a way they could tap into a program that actually will give them the balance of a 20% down payment? And that's really what co-ownership financing is. If you are short and you do not have a 20% down payment, you can tap into co-ownership financing. They will shore up and give you the rest of that down payment to make up the 20%. So what does that do for you? Okay, so let's take the Jones family, for example. So they qualified for the $400,000. Now, they only had $40,000 down. Now, with the supplement of the additional down payment, we are now able to take that mortgage and no longer it has to be insured. We extend it to 30-year amortization. So what it does is change their approval rate for a purchase price of $400,000 and it changed it up to $580,000. Okay, a significant difference to get them into their home. Let me take another example, the Smith family, for example. So the Smith family, they actually have a good day. They've saved $100,000 for their down payment. Issue is the husband is business for self. They have really good gross income. They bring in about $175,000, but they do a lot of deductions, so they net at about $85,000. That's basically their net business income. When we qualify on the A lending side or the banks, they always look for net business income. And this is the amount that we need to use. The other thing we look at too is your purchase threshold. So anything up to $1 million can be an insured mortgage. It allows you to put less than 20% down. As soon as you get above $1 million, you need a 20% down payment regardless. So in this particular situation with the Smith family, they had $100,000 saved. They actually had a good combined income because the wife on this side was actually salaried, and they qualified for about, say, $900,000, just a little bit under $900,000 with their $100,000 down payment. The issue is that the homes that they're like, they also have 4 kids. They're renting a home there. I think they're paying something like $4,200 a month for the home that they're renting. So the homes that they were looking in, anything under that price range, under $1 million, just wasn't fitting into what would be suitable for them as a family. Although when we looked at the ratios, they would potentially qualify for more than $1 million, but they just didn't have that down payment. Co-ownership financing shores that up. So we went from $900,000 to $1.150 million. So $1,150,000 was their new qualifying amount with co-ownership financing. Let me dive down a little deeper and show you how this works. Let's say the home price is $1 million. You know we need 20% for $1 million, but let's say I only have 5% saved. So 5% of $1 million is $50,000. With co-ownership financing, I could put down my 5%. The co-ownership financing program will put in the 15% to shore up the rest to give you a 20% down payment. So what it does is when I put in my 5%, they put in their 15%, it translates to an equity share. We now have an equity share in the particular property that we're purchasing. So how is the equity share calculated? Well, it's really based on what our down payment is. So if I put 5% down, they put 15% down, My 5% translates to a 25% equity share. Their 15% now translates to a 75% share. So if I put 10% down, mine would be 50% share, because their 10% would be 50% share, etc. So what this means is my 5% that I put down, my $50,000, actually translates to $250,000. So 25% of $1 million. Okay, so this is how this works. The co-ownership portion, their 15% would translate to the $750,000 equity portion of that particular home. Okay, so that's kind of how it's set up. So let me take you one step further, and let's say we're going to sell this home for 1.5 million. So let's see how this converts, this whole equity split, and how it translates. I'm selling it for 1.5 million. I started off with an $800,000 mortgage. I've been paying off the mortgage, so let's say the mortgage is now 700,000. So the net proceeds we have on this is 800,000. But wait a minute, I've been making these mortgage payments. Do I get credit for them? 100%. I get a full credit for that $100,000 principal. That goes right back to me. So now the net appreciation on the sale, okay, at 1.5 million selling when I bought it for 1 million, is actually 700,000, because I got a credit back for that $100,000 of principal. So now 700,000, 25% equity split. So my $250,000 that my 25% equity split translated to is now worth $175,000. So my $50,000 investment that I put originally had just converted and turned into $175,000 for myself. The co-ownership for their portion would translate to $525,000. You see how this works? And now if I put 10% down originally and the net appreciation was $700,000, mine would be $350,000, theirs would be $350,000. That's really how this works. That's really how simple it is. Let me kind of explain a couple of different scenarios. I'm giving up a portion of the appreciation of this home. Does that make sense? Or should I maybe just be saving all the way along and just try and get to the point where I can do it all on my own? Let's take this family. They had about a $5,500 monthly budget to cover savings for down payment and the rent. So they were actually renting a home for $3,500 a month, okay? So that gave them an extra $2,000 in savings per month. They actually already had $100,000 saved. So I'm already starting at $100,000 in the bank that they actually have saved. The property target that they're trying to get to, we're going to use the same example, $1 million. So they have $100,000 saved for this. Now, reminder that if you're buying a home over $1 million, you need a 20% down payment. They're saving money. So it would take them probably about 4 years, just a little over 4 years. Okay, so 4 years, $2,000 a month. Times 4 years, and try and invest it and stuff like that, so maybe you get some money. But if it's just straight savings, it'd be just a little over 4 years. But that same home, and let's say we know how houses are just going crazy right now. They're like, it's crazy the appreciation rates that these houses are having, especially within the Toronto and surrounding areas. But let's say we take a 6% appreciation rate. That same home that they were looking to buy that was $1 million 4 years ago is now worth $1,262,476 at a 6% appreciation rate. Okay, so even now I've saved my $200,000. I'm actually short still $45,249 for that down payment. Problem is, it's always a moving target. It's a moving target. I start to think, what would happen if I could go back in time and say, listen, if I bought this home using co-ownership financing, what would it look like? So we go back, $1 million house. I put $50,000 down. My rent that I was paying $3,500 a month for my rent, that portion, the mortgage cost for that, for the $800,000 has actually gone down. I'm actually going to be paying $33.73 per month instead of the $3,500. Now there's additional costs. You got property tax, you got utilities and everything else. So let's say that goes up to about $4,000. Let's say I still work with that $5,500 budget for my housing cost. Okay, so now let's say after all the cost of the mortgage, the property tax and everything else, say that's $4,000, gives me say $1,500 a month. I'm going to start putting aside for savings for additional down payment later on down the road, or for rainy days, or whatever it is. So let's fast forward 5 years from now. After 5 years, if I was putting the $1,500 away, I'd have about $90,000 in savings, okay, which is great. Now, after 5 years, let's say I'm selling that home for the $1.5 million, okay? After 5 years, I've actually paid off $88,000 off the principal, okay? So now I got my 90 plus my 88. My equity split that I showed you on the previous slides, 175,000. Okay, add all those two together. Now 5 years from now, I'm in a net position or an equity position of 353,000 that I can actually put towards my next home. Okay, there's my 20% down payment easily. It's leveraging the real estate to get to where you want to get to, and this is potentially a huge opportunity to actually get into those homes sooner. Right now, I'm looking at all the buyers that were just kind of out of reach, and now introducing them to this concept, because a lot of people kind of put it on the shelf. They said, okay, we're going to wait, we can't do it, we can't afford it, or whatever. This may be the way to do it, so we would look at everybody's situation. Here's a question I get: Lorne, you know what, this all makes sense, it all makes perfect sense, but you know what, I'm just a little bit weary about having co-ownership situation, having somebody on title and stuff like that. It's called co-ownership financing for a reason. It's not really co-ownership ownership, it's called co-ownership financing. Now, so here's how it works. Co-ownership financing can be up to 10 years. So after the 10-year mark, they're gonna say, listen, you gotta pay us out, or if you sell your home anytime before then you're obviously everything's paid out at that particular time. The co-ownership entity, the people that actually gave you this deposit to get it down, they're not on title. Okay, it's only you on title. There's no liens, no loan payments, no obligations other than maintain the home is really what it is. And the cool thing is they share the risk, right? Because they are actually throwing that money down for you to get into that home, and they're banking that the values are going to be increasing, but they will share that increase or decrease whenever you sell that home. And you can sell it at any time. There's no obligation to keep the home over a certain period of time. You can sell it at any time. You can even, if you choose to, you can even refinance to pay out that co-ownership in advance. So you don't necessarily have to wait for the full 10 years. You can move your financing from different institutions. There's really just there's a beneficiary agreement that's in the background that exists, that's executed on the sale of the home that protects them from you selling the home and them not getting paid, right? So basically that's how it is. But really, that's really super simple. Keeping it simple like this is a really great feature of co-ownership financing. Is this available everywhere? Unfortunately not, okay? But it is available within the GTA. In particular, these locations, you have Toronto, York, Durham, Peel, Halton, Dufferin, and Simcoe. Okay, right now those are the areas that this program is available. Why co-ownership financing? Well, definitely it can get you into a home much sooner. Closing cost is actually split. So basically whatever my portion of the closing cost is, whatever my portion of down payment, that would be my portion of closing cost as well. And the investor only succeeds if you succeed as a homeowner. How much can I purchase under co-ownership financing? You can put as little as 5% down up to 2.5 million. Okay, so that's where the threshold is. You do need to fully qualify with your mortgage, and ratios need to come in line, but that is really how it works. Other features that you get too is that if I have a less than 20% down payment, I'm paying insurance fees, all of a sudden I'm going through co-ownership financing, I'm no longer having to pay those insurance fees. In that one example that I gave with the business for self couple and 900, their insurance fees was going to be close to like $32,000, right, for their down payment and what they were looking for. That's a lot of money saved. There's a lot of advantages to co-ownership financing. If you want to find out if it's right for you, don't hesitate to make an appointment with us. There's a link in the calendar below, and just reach out. We're here to help. Looking forward to seeing you in our next video.